Hey everyone, how's it going? So one of the questions I see asked a lot is, how do you hedge your portfolio? And the answer is normally you buy puts. But I think the real question should be, what puts should I buy and how much do I need? How many puts do I need to hedge my account? And one way to kind of get a rough estimate for that is to beta weight your portfolio to another ETF, such as, say, the SPY. You could also do this with the QQQ or the IWM. But for the purposes of this video, we're going to use the SPY. And if you're not in Thinkorswim, if you do not have Thinkorswim, you can actually download the Thinkorswim platform and use the paper money trading application to track your trade. So if you're on Robinhood, you can download this. Last I checked, it's free. It doesn't cost anything. You can open up the paper money, put all your trades in, and then you can beta weight your account basically for free here. So what we want to do, we're in the monitor tab, and we want to make sure that Delta is showing. And if Delta is not showing, we'll go to the gear icon. We'll look up Delta and then basically just add it over and hit OK. And we can see right now it's showing we have roughly 17,000 deltas. And one share is equivalent to one delta. So we have 100 shares here, and that means we have 100 delta. So we have 17,000 deltas. And what we want to do is we want to beta weight this to the ETF SPY. And to do that, we'll just come up next to position statement and we click on beta weighting. And once we click on that, now we can choose the stock or ETF we want to weight this to. And like I say, we're going to use SPY, SPY. I like SPY because SPY is very liquid. It's probably one of the most traded stocks or ETFs out there. So it's really easy to trade in. QQQ and IWM both are very liquid too, but SPY does 2 to 3 times more the volume in contracts that the others use. So we can see now that we have weighted our portfolio to the SPY, we have 878 SPY deltas. So what this means, for every dollar that the SPY moves, our account is going to move $878. So now we want to decide how much we want to hedge this account. So first, let's go ahead and just 882. Let's just put 882 right here. And we're going to do times, and now we need to decide how much we want to hedge this. So if we wanted to be fully delta neutral, that means that pretty much our account is going to stay the same for the most part, no matter what SPY does. If SPY goes up, it's going to stay the same. If SPY goes down, it's going to stay the same. If we were to do that 100%, what we would do is we would buy 882 deltas worth of puts. And to do that, you just go in the trade tab. You could open up an expiration, and you want, 800 deltas. So that's how you would do it for 100%. But let's say that we don't want to do 100%, because let's say we want to do, say, 50% or 30. So what you would do is you do 882, that's how many deltas we said we had, times 50%. So that's going to give us 441 deltas. So to hedge this for 50%, to hedge 50% of our account, we need to buy 441 SPY put deltas. And that will hedge us in case the SPY drops. Now, to decide what put to buy, first you need to decide how far out in duration you want. Do you think the market is just dropping? Is it short term? Is it long term? If it's short term, you could do 1 to 2 weeks. So you could come out to the October expiration here, and I think you're going to be much better purchasing deeper in the money puts. Normally about 85 is kind of the go-to that I know a lot of people use. just because of the money that you spend and the amount of movement that you will get. You're getting basically the equivalent of 85 shares here for $1,200. If you want to get the equivalent of 15 more shares, it's going to cost you roughly $1,800 to get the 100 delta. So a lot of people like to stay around 85. So what we want to do, if we need 441 deltas, we can just divide that number by 85. And that means that we need to buy 5 puts. So 5 puts will hedge this account or roughly 50% of this account. 5 puts will hedge it for the next 16 days. So if we look at our 5 puts, if we want to analyze that, we can see that's giving us roughly 417 deltas right here, it shows. And this is going to be what's going to happen as SPY moves. We can see that if SPY trades flat the next 2 weeks, we're not going to lose too much money. We're looking at roughly almost $6,000 worth of a hedge here at 1,200 times 5. And we can see if it stays flat, we're only going to lose, at most $600 if it stays flat. And we wouldn't fully lose that all the way until about 450 is where we would lose the full price of this put or of this hedge. But we can see as the stock price drops, then it's going to make money, and it doesn't really matter if it's tomorrow or if it's 15 days from now. It's pretty much going to make kind of about the same amount or very close to the same amount of money. It doesn't really matter how many days, and that's for the next 16 days. So now we'll do that again. Let's say that 50% is too much. Let's say that we want to hedge it for 30%. So we would do 882 times 0.30. So we only need 264 deltas now, and we still want to use our 85 put. So we'll divide that by 85. So now we only need to buy 3 contracts. So hopefully you kind of see where this is going. It's pretty easy to calculate. It's not very hard to, pick something. At least it's going to give you kind of a foundation to build from on what to choose. So, like I say, try and stay close to the 85 delta because that's going to give you the least amount of theta decay for the money. So one final thing, let's say that you have a smaller account and you don't have all these deltas. Let's say that you only have, say, 20 or 30 that you need to hedge. So if you have less than 85 delta that you need to hedge, if it's between 20 and, say, 70, I don't recommend buying the 20 delta put. And the reason for that is because this is out of the money, it's going to have a lot of theta decay built into it. So we can see that, this is the stock price right now, I believe. And as the days go by, our break even gets lower and lower. So we need a big move on the stock for this hedge to actually take place. And if we get a large move soon, it'll work out great. But if it takes a week and a half, if we're in the middle of next week, we're just barely breaking even at, say, $4.30 a share right now. And if it's almost 2 weeks later, we're not even making money right here at even $4.20. If it's on the day of expiration, we're actually down $120 on that naked put because of all that theta decay it has built in. So one thing that we can do, instead of buying the 20 put, I think it would be better to buy a spread, buy the 50 delta and sell the 30. and we can see the buying the 50 and selling the 30 is going to be roughly $266. If we go to the 20 delta, it's roughly the same price, $259. We're within $6 there, and we're still getting basically our 20 delta hedge. And if we want to analyze that, we can see now our break even is much higher, much closer to the stock price. You know, our break even's at 434 on the spread, and we still have the 20 deltas. And if we go back to the single, our break even is all the way down at 417. So the spread is going to work much better. And you know, if you need 40 deltas, you could just buy 2 of these spreads. And if you buy 2 of them, that's what it would look like. So that's what I recommend doing if you have a smaller account and you want to hedge. You're going to be much better doing that. I mean, it's the single, you're going to need a big move there. And it's just, I think you're going to come out better buying the spread here. The probabilities are going to be better. You can make more money on just the naked put right here. And one last thing, if we look at the volatility, let's say we have an increase of 15%, you know, that is going to help this a little bit. But it still needs to move for you to make money. Whereas the vertical, you know, it's going to be making money regardless if volatility goes up. So anyway, hopefully this was helpful. And thanks for watching, and have a great day.